For as long as nations have existed, they have borrowed. Ancient kingdoms borrowed grain, medieval empires borrowed silver, modern states borrow money. But the one question that echoes across all of history remains unanswered. When every nation owes a debt, who stands on the other side of the ledger? Who is the world's final creditor? In 1790, when the United States was barely a young republic, Alexander Hamilton faced the same question. The new government was drowning in war debt. Europe refused to lend anymore. Banks were small, fragile, barely capable of funding a city, let alone a country. And so, Hamilton turned to the only creditors powerful enough to save a nation at that time: wealthy families, private financiers, and foreign investors who operated outside any government structure. History doesn't repeat, but it rhymes. Because more than 230 years later, the world is back in the same position. Nations owe more than ever. Traditional banks can't lend enough. And once again, power has shifted to private creditors operating in the shadows. But this time, their power is far greater than anything Hamilton ever faced. Today's lenders don't sit in marble halls or gold-filled rooms. They sit behind algorithmic trading systems, offshore servers, private funds in tax havens, and investment vehicles with no physical address. They can move billions with a swipe. They can freeze a country's economy without speaking a word. And unlike governments, they have no voters, no citizens to protect, no national interest. And yet, they hold the fate of nations in their hands. Before we go deeper, imagine this. It's the year 1875. The Ottoman Empire, once one of the strongest empires in the world, is collapsing under massive debt. European banks refuse to lend, so private financiers step in. They offer loans, but with brutal conditions: higher interest, full control of customs revenue, even political influence. Within years, the Ottoman Empire becomes financially enslaved to its creditors, and by the early 20th century, the empire collapses. The lesson should have stayed with us, but the world forgot. Fast forward to today, the same cycle has returned, just more complex, more global, and far more dangerous. After the 2008 crisis, governments blamed banks for the collapse, so they tightened regulations, increased capital requirements, and forced banks to reduce risky lending. Banks became safer, but something unexpected happened. A new financial ecosystem emerged in the shadows, bigger, faster, and impossible to control. Hedge funds, private credit firms, money market giants, sovereign wealth pools, offshore investment vehicles, algorithmic debt traders. These institutions stepped in where banks stepped back. And in just a decade, they quietly became the world's biggest lenders. The world calls them non-bank financial institutions, but history will remember them by a much simpler name: shadow creditors. And today, more than half of global debt issuance, government and corporate combined, flows through these shadow creditors. This is the part people don't realize. When a country issues a bond today, there's a very high chance the buyer isn't a bank or another government or the IMF, but a private fund managing billions for anonymous investors. These funds don't just invest, they shape economies, they influence interest rates, they determine whether a country survives a crisis or collapses into it. And here's the hook no one sees coming. These shadow creditors are not accountable to citizens, governments, or global institutions. They're accountable only to returns. And when profits decline, nations become expendable. Let's slow down. Imagine the following scenario, because this is a real pattern happening across multiple continents. A developing country is struggling. Inflation is rising. Elections are coming. The government needs money to pay salaries, build infrastructure, keep the economy afloat. Traditional banks refuse to lend at reasonable rates, so the government turns to shadow creditors. These funds appear friendly at first. They buy bonds, they inject capital, They give the government a lifeline. But in exchange, they demand high interest rates, sometimes the highest in the world. The country becomes dependent on them. Then, a small event happens. A political protest, a currency dip, a change in U.S. interest rates, something minor. But shadow creditors don't think like banks. They act instantly. They sell everything. Billions exit the country in a matter of hours. The currency collapses. Prices rise. Food becomes scarce. The government faces protests and, in many cases, falls. This is not a theory. This is the exact mechanism behind multiple crises in the last 20 years. In 1997, hedge funds triggered the Asian financial crisis by attacking currencies across Southeast Asia. Currencies lost 90% of their value. Millions fell into poverty. In 2010, bond market pressure nearly destroyed Greece's economy. Yields skyrocketed because private investors panicked. In 2020, the UK, one of the richest nations in the world, watched its bond market collapse within hours because pension funds used shadow lending strategies that backfired. And in 2024-2025, emerging nations from Pakistan to Argentina to Ghana reported the same pattern: private funds acting faster than regulators could react and causing catastrophic financial volatility. This brings us back to our question. If every nation owes money, who is the world's final creditor? The uncomfortable truth is not a single entity. Instead, a chaotic ecosystem of private funds, offshore institutions, anonymous investors, algorithmic debt traders, and global capital pools all acting independently, without coordination, without accountability. This is the first time in history that the world's financial backbone has no central structure. And that is the real danger. When banks dominated lending, at least regulators could intervene. When governments lent to each other, diplomacy could stabilize conflicts. When central banks controlled markets, they could calm volatility. But today, the creditors are too fragmented, too fast, and too opaque. If a crisis starts, no single institution can stop it. And here's the final twist. Many of the world's biggest shadow creditors are themselves borrowing heavily. They are leveraged, which means a crisis in one country can trigger a chain reaction that spreads globally at the speed of light. One nation struggles, hedge funds panic, they sell, prices crash, hedge funds face losses, they sell assets elsewhere, global markets fall, other countries collapse. A sovereign debt crisis can become a global liquidity crisis in minutes. This is why the IMF in 2025 issued its most alarming warning to date. Shadow creditors represent the largest systemic risk of the modern era. And yet, the world continues to rely on them. Because governments need money, banks won't lend enough, and global economies are too addicted to borrowing. We have built a system where nations depend on lenders who owe them nothing. So the final question remains: if the world's lenders collapse, who saves the nations? And if nations collapse, who saves the world's lenders? History tells us that every financial era ends with a reckoning. The gold standard fell, Bretton Woods collapsed, Lehman Brothers triggered a global meltdown. And now, the age of shadow creditors is approaching its breaking point. When the next crisis arrives, it will not look like 2008. It will be faster, sharper, and more unpredictable. Because the lenders controlling the world today were never designed to protect it. If today's deep dive gave you a clearer perspective on the forces behind global finance, make sure to subscribe to History of Finance Decoded. Every like, share, and subscription helps us bring you more evidence-based stories and historically accurate financial insights.